just tuning in, Al was shedding some light on how us as a retail or the average investors can create a plan by having a different mindset in your trading or in your overall finances. It comes down to understanding where prices turn and where they will go and how the institutions are moving these markets. And it's not the public. So the key is to trade like them. And that's kind of how I want to get into this next topic, Al, is the institutions. They are doing things, I mean, quite frankly, very different than the retail or the average trader and investor is doing. It's just the way it is. But they're not doing strategies that aren't available to the public.
That's right.
The strategies they're using are available to us, but the public just aren't taught how to do them unless you learn how to do it at an education facility. And like online trading academy, there's skills that people want to learn to be able to do that. Now, what do you think? I mean, you talked about conditioning. We're conditioned to do certain things. We're conditioned to read books and all that stuff. And we all know that's, information that usually doesn't work. And they're, quite frankly, books that were written years and years and years ago.
Sure.
Now, how do you help a lot of people that you're talking to? How do you help them become confident, understanding the strategies that those institutions are utilizing?
Well, number one, you want to put the odds in your favor. In anything you do, you want odds in your favor that what you're doing is going to work the way you want it to work. So stacking odds in your favor is probably the number one thing that you need to try to achieve. And then how you do that is by you setting the rules. If you set the rules that are going to be specific to your style of trading, what your goals and your expectations are, then the odds are in your favor because the person who sets the rules stacks the odds in their favor. And then the important thing is just having the discipline to follow the rules. Well, that comes with the confidence of knowing that what you're doing is going to work on a consistent basis, at least give you the opportunity to have it work on a consistent basis. There is really kind of two parts to any kind of trade. One is the mechanical part of it, putting it together, and the other is the psychological part of it. And that psychological part is the part that really where most people fall short because they let emotions dictate their investment decisions. And that's what you want to get away from because the emotions will have you do the opposite. So how do you control the emotions? And this also is one of the things that increases the confidence is that you follow a strategy that takes you down a path, so to speak. It's sort of like having somebody take your hand and walk you through a maze. And each step that you go is a set of rules, or it follows a rule that you follow. That set of rules will get you to the point where you identify one of those quality trades that I mentioned, or it may tell you that this is not a quality trade. Stay out of it. And what I'm talking about is a trading platform, a trading analysis platform that our students have called Click, which does, in fact, do that. It takes you down that path. It tells you with a grade whether this is a good quality trade, or it will come up with a little box saying, hey, you know what? This isn't a good trade. This violates one of your parameters. This is not a good thing for you. So it kind of keeps you out of your own way there. But by following a set of rules, you are following something that doesn't require thinking, which is going to be one of those things that gets in your way.
Right. Well, think about that. If you had something that could guide you through your decision process, that would make things much more comfortable in your decisions.
Yeah. And then you started this segment out by talking about the institutions and their short-term goals, their short-term income goals or cash goals. Well, we call them the smart money. It could be the major brokerage firms, hedge funds, big time people like Warren Buffett. That's the smart money. Well, they understand the value of short-term trading opportunities, which are there on a short-term daily basis. Really, they're unlimited.
And that's not day trading, though, is it?
No, I don't mean day trading, although we have some students that want to do that. That's fine. Our education is geared towards your style of trading. You may be somebody who only wants to make one investment a year or every other year. That's fine. If you want a short-term trade, if you want to be more of a passive kind of an investor or a long-term investor, the strategy, the basic core strategy, the foundational strategy that we use is the same, regardless of the time frame and regardless of the asset that you're trading, which helps to simplify things. But the institutions know that there's some real value in short-term opportunities, which again you have access to. But their portfolios don't stay the same. They don't just put one portfolio together And that's what they rely on for years or decades, like they tell you to do. They're
Amazing.
frequently making changes. They're not all in the same stocks. They will rotate from sector to sector, industry to industry. They use different assets to maximize their odds of success. Why don't they tell you to do that? Well, for one, it's too much work. Advisors might have several hundred clients that they have to deal with. It's really not possible for them to properly manage a couple hundred portfolios for short-term trading. It's a very good business model they have where they will take your money, put a portfolio suggestion together, and then just tell you to hold on to it through market gyrations, through the corrections, through the bear markets. Well, and the point there is that the market always comes back. It always has. It probably always will. But every time you let something be taken out of your portfolio, value taken out, even though you don't close it and lock in a loss, and that's what they'll tell you, as long as you stay in the trade, you haven't booked a loss. So the market's going to come back. But what if it takes 5 years or 10 years or 15 years or 20 years to get back what you lost? Because that can happen, and your portfolio has to work harder. Whatever the downturn is, percentage-wise, you have to have a higher percent return just to get back to where you were before you have the potential for any profit.
That's one of those, I want to just double down on that. That's one of those conditioning things that we're told, like you said, the markets have gyrations and it always comes back. You made an important point there. That money is gone, even though you haven't closed out that position. That's out of your account. And a lot of people think that it's not a loss until you close the account. It's a loss because the money is gone. But that's why it's so important to understand these shorter term trading, styles, because that way you're not stuck to just a buy and hope. Oh, excuse me, buy and hold strategy.
I caught that. That was
Yeah.
good.
But you want to stack the odds in your favor. You were explaining that earlier. It just reminded me, and a lot of people probably were probably listening and saying, "Hey, I was that kid that I was creating these different games, and I always put the odds in my favor so I would
Sure.
win." Well, that's the same thing that you want to do when you're trading and in your investments. Stack the odds in your favor to have better opportunities in those accounts. Al, you mentioned earlier the institutions are not just in stock, but they're in all assets for short term and midterm and longer term investing. They're not just stuck in stock. They're definitely not in mutual funds.
Yep.
Now, those other assets are available to the public as well. It's futures and it's Forex. Phenomenal markets, and we're seeing so many people coming into these investing classes begging to learn more, I think, on what those are. How can they utilize them? How can they utilize the time horizons, capital that they have, the requirements and stuff? Let's talk about that.
Well, here's the interesting thing: the big firms out there, many of who you are clients of, are not trading the same thing you are doing. Why are they putting you in mutual funds if that is the case for you, and then they don't do that? Why don't they teach you or guide you towards some of the things that they're doing? Because they are doing something different than most of their clients are doing. And here's a good question to ask yourself: do you know how to make money in an up market? If you buy something and you're correct in your buying decision and it goes up in value, you will make money, whether it's a stock or a mutual fund. But the market,
let's reword that. You have the potential.
That's a good point. It's just because the market goes up does not mean you will make money. You have the potential, but you know what? That's potential in only one out of three directions. So ask yourself how you have the potential to benefit in a down market. How do you have the potential to benefit in a sideways moving market? Do you know how to do that? And if not, why not? Because your brokerage firm, the financial institutions are doing that. It really doesn't make any difference to them which direction the market is going. They will do well regardless because they understand that there are strategies that can be utilized in an up market. There are strategies that can be utilized in a down market. And there are strategies that can be utilized in a sideways market, all of which have the potential of benefiting you. But you are participating in a down market. If you are just long something that will only benefit you if the market goes or the asset goes up in value, and it goes the opposite direction. You're participating, but not in a way that you want to participate.
So let's talk. What's the futures market?
The futures market is basically what it says. You're looking at what something will be worth in the future. It's a great asset family for proper diversification. In that market, and within the futures market, you can trade the stock markets, the major stock markets, both the our markets here and global markets. You can trade commodities. You can trade. I'm getting to it. Don't worry. Sugar, soybeans, corn, and
lean hogs.
Lean hogs, Josh's favorite. You can trade oil, gold, silver, currencies, interest rates. What I just described are a number of different assets that can be utilized in a way that you have great diversification. There are some things that might be correlated to each other. Some things are inverse correlated or reverse correlated. For example, gold and the stock market. Typically, when the stock market is going up, gold will go down and vice versa. There are assets that are not correlated at all. Lean hogs and the S&P 500. There's no correlation there. So
I don't think so.
You have the opportunity to provide true diversification, not just stocks that happen to be maybe in the financial area, the healthcare area, technology area, consumer staple area. They're all stocks. And when the market is correcting or crashing, the correlation between all stocks becomes very high. So the good companies get taken down with the bad ones. Well, with the futures market, you can have great diversification. You can participate in up markets, down markets. That's open almost 24 hours a day and has great leverage.
That is, phenomenal. Think about that. If you had a market that offered leverage, that offered true diversification, but also offered a 24-hour opportunity. Basically, what that means is you have the opportunity to trade any time of day. You're not required to trade 24 hours a day. You have the opportunity to pick your time. If you want to trade at 8 p.m., it's open. It's available. You can do that. You want to trade at 8 in the morning, you can do that. So people that work during the day have the opportunity to participate any time of day. Al, coming up next, I want to cover a couple different topics, but there's a lot of listeners right now that are, maybe where they were forced to retire this past year, or they're just saying, you know what, I just want to be done and I want to be able to retire, but I want to retire with confidence. So coming up next, I want to talk about retiring with confidence. But in my opinion, let's talk about probably the slowest, best market to trade any time of day.
I think I know where you're going with that.
This is Josh and Al. We'll be right back.